Hi, this is Marcus and this is your weekly wrap-up for last week. On Monday, stocks saw little change at the start of the session with European markets shuttered for Easter Monday. However, they changed quickly once the March ISM index was reported below expectations. The index was reported at 51.3, which was its lowest reading since December, and it sent the major averages to their lows with cyclical sectors pacing for the decline. The SPDR Industrial Select Sector ETF XLI fell 1.2%. Transportation-related stocks did their part in pressuring the space as the Dow Jones Transportation Average ended lower by 1.5%. All 20 stocks comprising the transportation average settled in the red, and the truckers were among the weakest performer. Equities sent the bulk of Tuesday's session near their highs before a late afternoon stumble dropped the S&P 500 back near the middle of its range. As a result, the benchmark average finished higher by 0.5%. Notably, the Russell 2000, which tracks small-cap stocks, ended lower by 0.5% after losing more than 1% on Monday. The healthcare sector showed strength out of the gate with managed care stocks jumping after the Centers for Medicare and Medicaid Services said 2014 Medicaid Advantage and prescription drug benefit rates will increase by 3.3%. Dow Component United Health Group gained 4.7% for the day. Wednesday saw a steady decline and the S&P 500 settled lower by 1.1%. Notably, small-cap stocks extended their recent weakness as indicated by a 1.7% decline in the Russell 2000. The Dow Jones Transportation Average finished lower by 1.3%, with airlines leading the decline. Delta Airlines and United Continental both lost 2.5%. Notably, Wednesday marked the third consecutive session, which saw the bellwether complex end with a loss of at least 1%. On Thursday, equities begin the day on a mixed note. The S&P 500 climbed higher out of the gate while Nasdaq slipped into the red, where it spent the majority of the session. After the prior day's sell-off caused the benchmark average to slip 1.1%, a handful of Wednesday underperformers began among the leaders. However, the early leadership did not hold into the afternoon as some defensive sectors began appearing atop of the leaderboard. Counter-cyclical telecoms and utilities climbed throughout the day and saw the largest gain. The majority averages ended today's session with modest losses. The S&P 500 shed 0.4% while the tech-heavy Nasdaq lost 0.7%. The bulk of today's selling occurred at the open as 3 points of concern sent investors in search of safety. Headlines from Asia indicated North Korea has not toned down its war rhetoric, and South Korean officials confirmed that the North has moved a pair of mid-range missiles to its east coast. In addition to the Korean concerns pressuring the broader market, disappointing second quarter guidance for F5 networks contributed to the relative weakness of the tech sector, which ended as the day's biggest laggard. While the two items pressured index future in pre-market trade, a disappointing March non-farm payrolls report ensured a sharply lower start to the cash session. Non-farm payrolls added just 88,000 new jobs in March. That was down from an upwardly revised 268,000 additions in February and was the smallest increase in jobs since June 2012. Although the three headwinds caused the S&P 500 to start lower by 1.3%, the benchmark average notched its lows during the opening minute before spending the remainder of the day in a steady climb. The S&P 500 index finished last week down only 1% despite a spate of negative news, ending with a poor jobs report on Friday. The Dow Industrials finished the week relatively flat after rebounding from Friday morning's sell-off. Other major indices fell more, led by the Russell 2000 Small Cap Index, falling 3%, and the Dow Transport diving 3.5%. Volumes remain low but picked up on down days in the overall market as investors are showing more signs of nervousness in equities. Investors plow into bonds again, which may have led to a short squeeze after traders have been speculating that treasuries would fall. The 10-year note yield traded as low as 1.67% on Friday, which was its lowest level since the end of December. Many market watchers are starting to feel the Fed may now extend their asset purchases for a longer duration due to the stalling of job growth. This sent investors fleeing back into the safety of US government debt. The start of the second quarter was met with jeers as economic data also shows slowing growth in the manufacturing and services sectors along with the poor jobs number. Historically, the second and third quarters are the slowest of the year and may put a damper on the first quarter's relatively strong growth. Any further dovish statements from the Fed could also reinforce rumors of no near-term change in their stance on fiscal policy. The impact of the sequester or automatic spending cuts has not shown up in recent data but also could throw a wrench into the second quarter numbers. This could all lead to a potential market pullback or consolidation that many traders have been predicting. The Chicago Option Exchange Volatility Index finished the week up 9% as stocks finished the week on a sour note. The fear gauge chopped back and forth for the most of the week, but is still historically low despite the global economic headwinds. News out of the Eurozone and emerging markets continue to disappoint and their markets are trending lower. Japan's new leadership released a plan to ramp up their accommodative stance by purchasing more assets and flooding the currency market with more cash. This sent Japanese market sharply higher but raised a few eyebrows from major investors. Markets are also on high alert for news from North Korea as leadership there continues to threaten South Korea and the United States. Any further deterioration in the resolution may quickly send markets lower. There is a plenty of potential market-moving economic data due out this upcoming week. Investors will particularly watch for reports on the FOMC minutes, which is on Wednesday, weekly jobless claims on Thursday, and the Friday's PPI, retail sales, and consumer sentiment data. First quarter earnings will also begin to trickle out with a few blue chip companies reporting Alcoa on Monday and JP Morgan Chase and Wells Fargo on Friday morning. On top of the release of the Fed minutes on Wednesday, at least a half dozen appearances by Fed officials, including Fed Chairman Ben Bernanke, are coming this week. This could provide some insights into Fed policy after the recent negative data. And this wraps up the market report. So I'll be seeing you next week. Bye for now.